Hi guys, it's Stock Harry, and as we wrap up one of the worst years ever in the stock market, it's time to start focusing on 2023. In today's video, I'm going to show you some data to show you how the market might trade next year. So let's get into it. This is how the data shows the market will perform in 2023. If you lost money this year, don't feel bad. Most market participants lost money this year, including some of the largest institutions and hedge funds in the entire world. So if you lost money this year, most likely you're in the same boat as about 90% of investors. The question now is, how is the stock market going to trade in 2023? Are we going to be able to recoup these losses, or are we headed for even more losses next year? Most people think the stock market is going to go down next year as the U.S. economy enters a recession. But the real question, first of all, is why would the market continue to fall after it's already fallen so much this year? And if the market does fall in 2023, just how much will it fall? To answer those questions, we have to take a look at some historical analysis and see how the stock market has historically performed during other recessions and other recent bear markets. The first thing we have to take a look at in order to understand how the stock market might trade next year is understand where we stand today. And the easiest way to understand where we stand today is not to look at the price of stocks or how much they've risen or fallen, but rather to look at something called a PE ratio, or price to earnings ratio. And this is simply the price of a stock divided by the earnings per share averaged over the entire index. On the top here, we have the Dow Jones average PE ratio, and the Dow Jones Industrial average PE ratio is currently sitting at 20.66, with future earnings sitting at 18.17. Now, generally, the stock market is going to trade based upon forward earnings guidance or future PE ratios. So for the sake of this video, we're going to use these future earnings expectations or future PE ratios in order to do our analysis. So for the sake of the Dow Jones, we'll go ahead and use that 18 PE ratio. Let's take a look at how the other indexes currently stand. The Russell 2000 has a current PE ratio of 71. That seems quite high until you understand that a year ago, the PE ratio is 661. Now, that is, of course, much higher than, say, an average of 15 you might expect out of the Dow or S&P, but the Russell 2000 is made up of small cap stocks that are typically high growth stocks. So when we take a look at the forward PE ratio or future PE ratio, that is only at 22 on the Russell. Still a little bit high, but not extremely high. On the NASDAQ, we have a current PE ratio of 23 with a forward PE ratio of 21 on average. Again, still a little bit high, but not too bad. And then on the S&P 500, we have a current PE ratio of 18 with a forward PE ratio of 17. Now, these are just a bunch of numbers until we understand how the stock market has historically performed. So let's take a look at that at this time. This chart shows the S&P 500's PE ratio versus the historical average. And rather than giving actual numbers, we're going to focus more on percentages as a mix from the standard deviation from the historical average. So in the middle here, we have a 0% historical average. On the upside, you have the yellow line, which is a 1 standard deviation away. The red line, 2 standard deviations away. And then on the downside, we have the light green line, which is 1 standard deviation below, and the dark green line, 2 standard deviations below. Now, the peak of PE ratios in the S&P 500 was the internet bubble in the year 2000, when PE ratios were 127% above their average. Now, that obviously had to correct itself, and it did. PE ratios came all the way down to the historical average. Then in 2008, they rose up to 1 standard deviation away. And in 2008, in the midst of the financial crisis, PE ratios fell down to 1 standard deviation below the historical average, or 36% below the historical average. The historical average in the S&P 500 is around a PE of 15, and at the bottom of the financial crisis, PE ratios were averaging around 9. Then they rose back up, and we had one of the fastest bull runs in history, with PE ratios peaking last year above that 2 standard deviations above. PE ratios have now fallen significantly this year, with the average PE ratio now around 17. However, if we were to fall down to the 1 standard deviation below average PE ratio like we did in 2008 and 2009, we could be looking at another 40 to 50% drop in the S&P 500 in 2023, meaning PE ratios currently could fall from 17, where they're at now, down to 8 or 9. If you can imagine the S&P 500 falling another 50% from here, that would be an even greater drop than the 20 to 30% drop that we saw here in 2022, meaning the stock market could actually perform worse in 2023 than it did in 2022. Part of the problem that we're going to run into next year is that when you calculate a PE ratio, you're taking the stock price divided by the earnings. And there are 2 things that could cause that PE ratio to rise. One is the share price going up. So if the share price goes up, the PE ratio goes up. But let's say the share price stays the same. If the earnings go down, then the PE ratio goes up. And this is the problem we are currently running into. We actually hit a PE ratio of 17 earlier this year. And then when Q3 earnings came out, the PE ratios rose up to 19. And then recently we've dropped a little bit. We're back down to around 17. And as earnings continue to decline, and this pushes PE ratios higher, stocks will continue to sell off in order to maintain a 15 to 17 PE ratio. And this is the main problem that we're currently in, is we've fixed the multiples that we were dealing with last year when PE ratios were 38% above average and multiples were very, very high. That has been fixed now that stock prices have come down, but we have not yet fixed the PE ratio due to earnings. Earnings continue to go down, and share prices need to go down in order to keep up with those lower earnings. That is expected to take place throughout all of 2023. Now, all of that said, if the full decline through the whole year were to occur, we could expect the stock market to fall by as much as 50% from current levels next year. However, there is one caveat we have to remember, and that is the Federal Reserve. The Federal Reserve can flip everything on a dime. And this is exactly what we saw in the year 2020 when earnings tanked. The whole stock market was crashing. The whole economy was crashing. And the Federal Reserve turned everything around by doing massive quantitative easing, a ton of money printing, lowering interest rates, everything they could do to stimulate the economy. And this caused the stock market to rise despite the fact that earnings were continuing to go down. So at any point in 2023, we see the Federal Reserve stop raising interest rates and actually start lowering interest rates, we could see the stock market go on a massive rally. And in fact, the stock market could start going up 6 months before earnings bottom out. This is normally what happens. And this is why a lot of people think the recession will continue through the end of 2023, but stocks will actually bottom out around the middle of 2023, down another 20 to 30% from here. That is where a lot of people think stocks are going to bottom out. And then people think stocks are going to start to rise as the Federal Reserve pivots to bring us out of a recession. Here's why specific stocks are falling more than the overall market. As a massive blizzard and cold front hit the United States last week, this caused massive delays with over 12,000 flights canceled across the country, and Southwest being hit the hardest. They had to cut 70% of their flights as they try to get caught up. This caused Southwest stock to drop over 6% on Tuesday. And automotive stocks also sold off more than the overall market on Tuesday as people look forward to 2023 and realize that 2023 could be another very difficult year for the auto industry. High interest rates, supply chain problems, and recessionary fears were amongst the major challenges for the global automotive industry this year, and those issues are not expected to be resolved quickly. Now, most analysts expect global and U.S. auto sales to rise in 2023. But those sales increases will likely come at the expense of the unprecedented pricing power and profits that automakers have enjoyed on new vehicles over the last couple of years. To put it another way, high interest rates, growing recession fears, and too much inventory will force automakers to cut prices and lower profits. That will come as a cost to automakers and also their shareholders. So even though sales are expected to increase in 2023, profits are expected to decline as car makers lower prices in order to entice buyers. As a result, it's going to be very important in 2023 to pay less attention to deliveries and more attention to profits. On top of that, Chinese provinces were hit hard by COVID and are now seeing a strain on critical care, and health officials say that things are getting worse rather than better. As a result, Chinese EV maker NIO cut their delivery guidance for the fourth quarter, citing COVID disruptions, and Tesla is going to reduce their Shanghai production. Tesla will continue producing vehicles from January 3rd to January 19th, and then they're going to stop all EV production through the end of the month. Tesla had previously said they were not going to stop production. However, now they're coming out and saying that they will. This bad news caused Tesla shares to drop over 11% on Tuesday. Tesla stock is now headed for its worst month, worst quarter, and worst year on record. Tesla stock closed below a major support level of $111 on Tuesday. However, if you look at the daily chart on the technicals, you will notice how the RSI is at 16. And even on the weekly chart, the RSI is at 27. Keep in mind that any number below 30 points to a stock being oversold, and this is only the second time in Tesla's history where the weekly chart was oversold. We can expect Tesla to pause from falling from here. Tesla's next major support level is at $95, and their next major support level below that is at $57.50. Now, even as Tesla remains a falling knife and it starts to correct the PE ratios due to the fact that future earnings are expected to go down, Tesla's stock price on the technicals is pointing to at least a pause, possibly this week and next week, from this falling knife scenario that it's currently in before it continues to sell off. Keep in mind that as we are near the end of the year, a lot of people are selling their losing stocks in order to do what's called tax loss harvesting. That is, they are selling their losing stocks in order to make up for their winners earlier in the year so that they don't have to pay any taxes on their stock profits this year. And with Tesla now down 70% on the year, Tesla is one of the most heavily sold stocks going into the last week of this year, and that is why we are seeing it extremely oversold on the RSI. I do expect Tesla to rebound very quickly over the next week or two once we get through this selling season, and then we can expect Tesla to either trade flat or perhaps slightly up before it continues its downtrend in 2023 as earnings continue to go down and the share price has to go down in order to maintain the new PE ratio and lower earnings expectations for Tesla going into next year. If you got a lot out of this video, then be a good friend and share this video with your friends and family so that they will know what's going on in the market as well. And make sure you hit that like button and subscribe. And if you want to know more market news and what's going on, then I recommend you watch the last video that I uploaded here.